Okay, I want you to picture something with me for a second. Just close your eyes if you can. It is the middle of the night. Specifically, the date is Friday, February 20th, 2026.
A very specific moment in time.
Right. We are in the future, or, well, depending on when you're listening to this deep dive, maybe the recent past. But the exact time on the clock is 2:37 a.m. and 44 seconds, to be precise, Pacific Standard Time.
Which, if we're translating that, it puts us at roughly 5:37 a.m. over in New York.
Yeah.
And it's mid-morning over in London.
Exactly. So most of the Western world, at least in the U.S., is fast asleep. The streets are completely empty. But somewhere in a dark room, illuminated only by the glow of all these monitors, there is a pulse.
There really is.
It's like this heartbeat of the entire global economy just ticking away while the rest of us are dreaming.
Yeah, you're describing what we call the witching hour for the markets. It's this incredibly fascinating high-tension crossover period.
The witching hour. I like that.
It really feels like it because the Asian markets, so Tokyo, Sydney, Hong Kong, they are heading toward their close for the day. And then the European markets, London, Frankfurt, Paris, they're just waking up, right? The traders are brewing their coffee, turning on their terminals.
While the U.S. is still mostly in bed.
Exactly. But the U.S. futures markets are still ticking away in the background. They're electronically trading way before the actual opening bell rings in New York. So it's this very specific, very volatile time of day where all the global liquidity sort of shifts from one side of the planet to the other.
And what we are looking at today for this deep dive is a snapshot of exactly that moment. We have in front of us this single, highly complex dashboard. It's titled GDMAS.
The Global Digital Market Analysis System.
Right. And I have to be completely honest with you. When I first opened this file and looked at this image, I genuinely felt like I was staring into the Matrix.
Oh, that is a very common reaction. I mean, it can be incredibly overwhelming at first glance, especially if you're a beginner.
Overwhelming is, it's an understatement. It is just a massive wall of numbers. It's got what looks like a spaghetti chart of tangled colored lines on the left. Then there are all these columns of flashing red and green percentages.
And the tickers? Yeah.
Right. Ticker symbols that look like secret government codes. It really looks like the cockpit of a spaceship. Or maybe a trader's terminal just before a massive panic sets in.
Well, that is exactly what it's designed to look like. Yeah. You have to understand, these dashboards, they aren't built for beauty.
Clearly not.
No, they aren't built for user experience in the traditional, app design sense. They're built purely for density. They're designed to cram as much information as physically possible into a single glance.
Because time is money.
Exactly. Yeah. A trader might have literally millions of dollars on the line. They need to make a split-second decision, but, and this is the absolute key for us today, once you know how to read the matrix, a story actually emerges. It stops being just random noise, and it starts being a very clear narrative.
And that is our mission for this deep dive today. We are going to demystify this dashboard. We're going to take this seemingly chaotic snapshot from February 2026, and we're going to decode it piece by piece.
It's going to be fun.
Yeah, we want to take you, the listener, even if you have never traded a single stock in your entire life, even if you keep your savings under a mattress, we want to take you from being completely confused by all these squiggly lines to truly understanding the massive economic story that was unfolding on this specific Friday morning.
And it really is a fascinating story. I mean, there is genuine drama hidden inside these numbers. You got winners taking a victory lap. You have losers falling completely off a cliff. And there are some truly bizarre anomalies happening in this snapshot that we really, really need to unpack.
Before we dive right into the alphabet soup of the tickers and the charts, there's actually this line of text right at the very top of the screen. It's in this black banner.
Ah, yes. The disclaimer.
Yeah, it says, quote, "This channel does not provide buy or sell signals, entry points, targets, or financial advice. All content is for educational and informational purposes only." Unquote.
The classic disclaimer. You see that plastered on almost every single piece of financial analysis software out there?
Right, mostly for legal reasons, I assume. But I actually think it serves as a really great hook for us today. It sets the ground rules for our conversation. We aren't here to tell anyone what to do with their money.
Especially since this is a snapshot from a very specific moment in the past.
Exactly. We are purely observers here. We are just looking at what happened.
That's the best way to approach it. We are like historians looking at a map of a battlefield, after the smoke is cleared. Or actually, in this case, we're peering through the fog while the battle is still raging at 2:37 in the morning. That disclaimer just reminds us to stay completely neutral. We aren't rooting for the dollar or Bitcoin or gold. We are just looking at the raw data to see where the money is flowing.
Okay, so let's crack the code. If you're a beginner and you look at this dashboard, you see a column labeled monthly or maybe base encounter daily, and under those, it's just a list of 3-letter codes. It basically looks like someone fell asleep on their keyboard. You know, USD, EUR, GBP, XAU.
It definitely looks abstract. But those 3-letter codes, they are the Rosetta Stone of the entire financial world. They're the ISO 4217 currency codes.
ISO what?
ISO 4217. It's just the international standard. But once you know them, you can read almost any financial chart anywhere in the world, whether you're sitting in New York or Tokyo.
Okay, let's run through the big ones that are appearing here on the board, just so we can get our bearings. We see USD. I think that's the easy one.
Yeah, the United States dollar, the world's reserve currency, the greenback. It is really the baseline against which almost everything else on this board is measured.
Makes sense. Then right below it, we have EUR.
The euro, used by all the Eurozone nations, so Germany, France, Italy, Spain, and so on. It's the second most traded currency in the world behind the dollar.
And GBP. That's Great British Pound.
Exactly, often just called sterling. It's actually one of the oldest currencies still in continuous use today.
Okay, and then JPY.
The Japanese yen. Now this one is crucial. Japan is a massive export economy, and the yen is quite often used as what's called a funding currency for big global trades.
What does that mean, a funding currency?
Well, historically, interest rates in Japan have been incredibly low, sometimes even zero or negative. So big investors will literally borrow money in Japanese yen because it's so cheap to borrow, and then they take that money and invest it somewhere else that pays a higher return. So when the yen moves, it causes ripples everywhere.
Wow, okay. That's good context. And then we have a few from the Commonwealth countries. I see AUD, NZD, and CAD.
Right, so that's the Australian dollar, which traders just call the Aussie, the New Zealand dollar, which is called the Kiwi, with the bird on the coin, and the Canadian dollar, which is the loonie, again, because of the bird on their $1 coin.
Traders really like their nicknames.
They really do. But these three, the Aussie, Kiwi, and loonie, they are often grouped together as what we call commodity currencies.
Because they export a lot of raw materials.
Exactly. Their entire economies rely heavily on exporting natural resources. Australia with iron and gold, Canada with oil. So their currencies often move based on how expensive those raw materials are globally.
Got it. And then there's CHF. This one always throws me off. It doesn't look anything like the country it belongs to.
Yeah, that is the Swiss franc. The CH actually stands for Confederatio Helvetica.
Oh, wow.
Yeah, which is just the Latin name for the Swiss Confederation. The F is for franc. And the Swiss franc is historically considered a very stable, very safe currency. It's a place where people park their money when they are genuinely scared of what's happening in the rest of the world.
Okay, so those are all the countries. But then, mixed right in with these country codes, we have these other codes starting with the letter X. We have XAU and XAG. This looks like something out of a sci-fi movie. What is the X factor here?
So this is where global finance kind of borrows from your high school chemistry class. These are commodities. Specifically, they are precious metals.
Okay.
In the financial system, these metals are treated almost exactly like currencies because they're global stores of value. The X basically denotes that it's a supranational asset. It's not any one country's money.
So, if I remember my chemistry, XAU.
Check the periodic table. Aui is the chemical symbol for gold from the Latin aurum. So XAU is simply the ticker for gold.
And XAG.
Ag is silver from argentum, so XAG is silver.
I love that. It honestly makes me feel smart just knowing it. It's like a secret handshake for the markets. And then I see WTI listed down there as well.
That stands for West Texas Intermediate. It is the main benchmark price for crude oil produced in the U.S. When you hear a news anchor in America say, oil prices are up today, they're usually talking about WTI. It's basically the lifeblood of the industrial economy.
Got it. So we have our fiat money, we have our precious metal, and we have oil. But the dashboard is called the Global Digital Market Analysis System. So of course, we also have the digital assets listed here. I see BTC, ETH, and BNB.
Right, the big three of the crypto world, at least in the context of this specific dashboard layout. BTC is Bitcoin, obviously, the original cryptocurrency. ETH is Ethereum, which powers a huge amount of the decentralized applications and smart contracts out there. And BNB is Binance Coin, which is the native token of the massive Binance exchange ecosystem.
And finally, in the top right corner of the dashboard, I see a different kind of code. Things like US 30, US 500, US Tech, UK 100, DE 30, JP 225. These honestly sound like robot names.
They do. But these are the equity indices. They represent the stock markets of those specific regions. So instead of looking at just one company like Apple or Ford, you look at a basket of top companies to see how the whole economy of that country is doing.
So US 30 would be?
The Dow Jones Industrial Average, the 30 big industrial giants of America. US 500 is the S&P 500, so the broader US market, the top 500 companies. US Tech is the NASDAQ, which is heavily tech-focused. UK 100 is the FTSE 100 over in London. D30 is the DAX, the German stock index. And JP 225 is the Nikkei index in Japan.
Okay. We have our vocabulary down. We know the players on the board. Now let's actually look at the field. I want to describe the layout for our listeners who are completely new to this because it really helps to visualize where we are pulling this information from.
Definitely.
So on the far left, taking up about half the entire screen, is this giant graph with squiggly lines all over it. Then on the top right, we have a little box called weakness and strength. Middle right, a big table called monthly, and the bottom right is a really complicated looking table called base and counter daily.
That is a very standard dashboard setup for a quantitative trader. The left side is purely visual. It shows you the trend over the last week, so your brain can just instantly spot the patterns without doing any math. Then the right side is data heavy. It gives you the exact numerical values for different time frames. It moves from the big picture in the monthly view all the way down to the microscopic detail in the daily view.
Let's start with that visual on the left, the weekly graph. It has a black background, and like I said, it looks like someone threw a plate of neon spaghetti against the wall. There are red lines, green lines, yellow lines, white lines, and they are all moving from left to right.
It definitely looks chaotic, but if you just trace the lines, it makes sense. This chart plots what's called relative performance.
Relative performance. Okay, explain that for me.
So all these different assets, the dollar, Bitcoin, gold, they all started the week at the exact same starting line on the left side of the graph. That's the 0.000% mark. The graph simply shows us who ran faster, who stumbled, and who fell off a cliff over the last 5 to 7 days.
Oh, I see. So it levels the playing field.
Exactly. It neutralizes the actual price difference.
Yeah.
So we aren't trying to compare a $50,000 Bitcoin to a $1 euro. That would be impossible to chart together. Instead, we're just comparing their movement relative to where they started.
Okay, so let's call the race. If I look at the finish line on the far right of the graph, there is one very clear winner. It's the red line.
And if you look at the legend, that red line is labeled USD.
The US dollar. It starts near the middle on the left, dips just a tiny bit, and then it just climbs. It's jagged, kind of like a rough staircase going up. But by the end of the week, so this Friday morning snapshot, it is sitting right at the very top of the chart, somewhere between the 0.5% and 1% lines.
That is a very significant move for a currency index in just a single week. Currencies are usually very, very stable. They usually only move in tiny fractions of a percent. So for the dollar to climb nearly a full percent relative to everything else, that tells us the US dollar was absolutely the king of this week. While all the other assets were fluctuating, investors around the world were steadily, consistently buying dollars. It's trending aggressively upward.
So the dollar is winning the weekly race. Now let's look at the losers, because there are two lines here that look like they just gave up on the race entirely, the white line and the yellow line.
Trace them back to the legend. The white line is labeled BTC-USD, that's Bitcoin. And the yellow line is BNB Binance Coin.
They start the week, maybe hovering right around that zero line. But then, man, they just crash. They drop off an absolute cliff. They go way below this 0.00% line, plunging down past negative 0.5%, past negative 1%. Visually, they're at the very bottom of the chart.
This is a textbook example of what traders call divergence. Just look at the overall shape. The red line, the dollar goes up, the white line, Bitcoin goes down. They're basically mirror images of each other.
So they move in opposites?
Often, yes. And this tells us that money is fleeing from the digital assets and it's fleeing to the traditional US dollar. It's a massive capital rotation. When the dollar gets really strong, risky assets like crypto almost always get crushed.
What about the other runners in the middle of the pack? I see a green line labeled CESTO-C.
That likely represents a basket of the major stock market indices combined into one metric. And you can see it's a bumpy ride. It's very volatile, bouncing up and down all week. But look at where it finishes on the right.
It finishes in positive territory, just slightly above that 0.00% line.
Right. So stocks had a choppy week. They struggled, but they managed to keep their heads just above water.
And then there's the orange line. That's XAU, gold.
Gold is super interesting here. Look at the beginning of the week on the far left. The orange line spikes up really high. It was actually winning the race early on in the week. It shot up like a rocket.
But then
As the red line, the dollar, started to climb, the orange line started to sink. It trends downward for the rest of the week, finishing negative, right below the zero line.
So gold had a false start.
You could definitely say that.
Yeah.
It tried to rally, tried to break out, but the sheer strength of the dollar, that rising red line, likely just pushed it back down. Usually because gold is priced in dollars globally, when the dollar gets stronger, gold becomes more expensive for foreign investors to buy, so the demand drops and the price drops. We are seeing that inverse correlation play out perfectly visually here on the weekly chart. The dollar basically bullied gold back down.
So if I'm a beginner just looking at this spaghetti chart, the main takeaway is pretty simple. Dollar is strong, crypto is weak, and everything else is just fighting for the middle ground.
That is the perfect executive summary of the weekly visual. Yes. If you walked away right now, that's the headline you'd take with you. But as always, the raw numbers on the right side of the board tell a much, much deeper story.
All right, let's move over to that top right corner then. The weekly weakness and strength scorecard. This basically puts the actual hard numbers to those racing lines we just saw. It's a list of the stock indices and the dollar, with percentages next to them. Some are bright green, some are bright red.
And this data completely confirms what we just saw on the graph. Look at the very bottom of that specific list, DXY.
DXY, okay, it says 0.92%, and it's bright green.
Right. So DXY is the ticker for the US dollar index. It measures the value of the US dollar relative to a basket of other major foreign currencies, mostly the euro, the yen, and the pound. It is up nearly a full 1% for the week.
And we said is a lot for a currency.
A massive amount. In the currency world, a 1% move in 5 days is a very solid, strong trend. It's kind of like a regular stock going up maybe 10% in a week. So this hard number completely confirms why that red line was dominating the race.
But look at the top of the list here, AUS 200. It's sitting at 0.91%. That's almost the exact same number.
Yep, the Australian stock market is having a fantastic week, almost matching the dollar's gains step for step. And this is a really important clue that we're going to come back to later.
Why is that a clue?
Because usually when the US dollar is sucking up all the oxygen in the room and getting that strong, foreign stock markets tend to suffer. But Australia is holding its own. It's performing exceptionally well in this snapshot.
I see the European markets are actually doing okay too. The UK 100 is up 0.62%. The FR40, that's France, right?
Correct. The CAC 40 index in France.
Okay, so France is up 0.42%. So Europe is holding up decently well. They are solidly in the green zone.
They are. But then we have the red zone. The losers of the week in the traditional stock market, and there's one really big red number here, JP225.
The Japanese Nikkei, it's down negative 1.80%. Whoa, everything else is either up or just slightly down, and Japan is down almost 2 full percent. Why would Japan be crashing while the US and Europe are up?
That is the million-dollar question for traders on this Friday morning. Often it has to do with the currency we talked about earlier. Japan is heavily reliant on exports. If their currency, the yen, gets too strong, it hurts their exports. Or, conversely, if there's worry about their central bank suddenly changing policy, the stock market can take a massive hit. Or it could simply be that global investors are pulling their money out of Asia and moving it to the safety of the US and Europe. We don't know the exact news headline, but on this dashboard, Japan is clearly the sick man of the global equity markets for this week.
Now what about the US markets? I see US 500 is green at plus 0.27%, but US 30, the Dow is red at negative 0.28%.
That shows what we call a mixed sentiment. The broader market, the top 500 companies, is slightly up, but the big old school industrial companies in the Dow are slightly down. It means investors aren't just buying everything blindly, they're being picky. They might be buying services or healthcare, but maybe they're selling heavy manufacturing. It generally indicates uncertainty in the domestic US market.
Speaking of being picky, US tech, the Nasdaq, is barely green. It's at plus 0.05%. That's basically flat.
Which is really surprising, because usually tech leads the charge during a rally. Here, tech is lagging behind the broader market.
Okay, let's zoom out. We've looked at the last week. But a week is just a blip in the grand scheme of things. To really understand the story of February 2026, we need to look at the monthly table right in the middle, right of the screen, because this is where the numbers get. Well, honestly, kind of shocking.
Yeah, this table changes the time frame to the last 30 days. And this is where the macro story, the really big picture, reveals itself.
I want to start with what I think is the craziest number on the entire board. We just talked about Australia having a good week. But look at the AUD row in this monthly column.
I see it.
Under the percentage column, it says 13.96%. And it's neon green.
That is astronomical.
Is that normal at all?
No,
Yeah.
Absolutely not never.
In the world of major fiat currencies, a 1 or 2% move in a month is significant. A 5% move is a major news-making trend. A roughly 14% move in a single month for a major developed world currency like the Australian dollar, that is monumental. It is an absolute outlier event.
It's the biggest number on the board by a mile.
It suggests something massive happened in Australia in February 2026. Maybe there was a surprise interest rate hike by their central bank that just drew in billions of dollars of foreign investment overnight. Maybe there was a massive commodities boom where suddenly everyone on Earth needed Australian iron and gold. Or maybe a geopolitical shift in global trade routes favoring the Pacific.
It's hard to even wrap your head around. Right, and comparing it to its peers makes it look even crazier. Look down at the CAD. The Canadian dollar is basically flat, down negative 0.79%. Look at the Swiss franc, CHF, basically flat at plus 0.16%. So Australia is entirely on its own rocket ship here.
But if Australia is the rocket ship, the UK looks like the sinking ship. Look at GBP.
Oh, wow.
Negative 10.81%.
That is a total collapse. A 10% drop in the British pound in 1 month is crisis-level volatility. That is the kind of drop you usually only see during major political upheavals, like a Brexit vote or a severe economic disaster.
So just to recap the major players here, we have the US dollar up about 2.16%, which is a very solid month. We have Australia up 14%, and we have the UK down basically 11%.
Think about what that actually means for the global economy, right? If you are a citizen holding British pounds, you have essentially lost 10% of your global purchasing power in 30 days. Everything imported just got 10% more expensive for you. But if you are holding Australian dollars, you've gained nearly 14%. This data suggests there's a massive economic shift of wealth.
Away from Europe.
It's exactly. Away from the UK and Europe. Because if you look, the euro is down 3.40% as well. And a massive flow of capital toward the US and specifically Australia.
It's like a tectonic plate shift. Old Europe is sinking and the Pacific and the US are rising.
Precisely. And remember our rule from the beginning. We are just looking at the raw numbers. We don't know the specific CNN or Bloomberg headline news that caused this, but the data screams capital flight. Money is leaving Europe and the UK as fast as it can, and it's parking itself in the US and Australia.
Let's look at the commodities in this monthly view, because that might give us another clue. We saw gold XAU struggling on the weekly chart, but on the monthly chart...
On the monthly, XAU is actually up plus 4.86%.
And oil, WTI.
Up plus 5.27%.
Okay, expert, you gotta help me out here. You told me earlier during the weekly chart breakdown that usually when the dollar is strong, gold is weak, because it gets more expensive. But here, on the monthly view, the dollar is strong, up 2%. ND gold is strong, up almost 5%. And oil is strong, up over 5%. Everything is going up together. What does that actually mean?
This is a rare and very specific market signal. When the dollar, gold, and oil all rise significantly at the exact same time, it almost always signals inflationary fear combined with a safe haven panic.
Inflationary fear. Okay, explain that simply.
See, if investors were just naturally optimistic about the U.S. economy growing, they'd buy U.S. dollars and they would sell gold to buy stocks. Because gold doesn't pay a dividend, it just sits there.
Right.
But here, they're buying dollars for safety. They're also buying gold for safety against inflation or potential currency collapse. And oil prices are rising rapidly, which is what causes inflation in the first place because everything costs more to ship.
So it's a feedback loop.
Exactly. It suggests the broader market is terrified. They are buying everything that is either tangible like oil and gold or universally accepted as safe like the US dollar. They are aggressively dumping risky currencies like the pound, and they're just hoarding hard assets.
That makes total sense. It's like the market is collectively saying, I don't trust the pound, I don't trust the euro, just give me gold, give me barrels of oil, and give me US dollars in a vault.
Exactly. It's a defensive crouch. They are preparing for a major storm.
Which brings us to the asset class that is decidedly not safe in February 2026. Let's look at the bottom of the monthly table, the crypto section.
Oh boy. This is an absolute bloodbath.
We saw the white line crashing on the weekly graph, sure, but the monthly numbers paint an incredibly grim picture.
Down negative 12.64%.
Down negative 13.55%.
The biggest loser on the entire board, down negative 19.67%.
That is nearly a 20% loss in value for Binance Coin in just 30 days. A fifth of its total market value just completely gone.
And there's another ticker here in the crypto section that I find really, really interesting. BTC XAU.
Ah, yes. Bitcoin priced against gold.
Right. It's down negative 16.63%.
Yeah.
Now, Why is that specific pairing so important?
That is a crucial metric for the crypto narrative. See, usually we price Bitcoin in US dollars, but a lot of massive proponents argue that Bitcoin is essentially digital gold.
Right, I've heard that.
They argue it's a long-term store of value, just like gold, but better because it's digital, it's easier to transport, and has a fixed supply. Well, this metric, BTC XAU, actually tests that theory in real time. If Bitcoin was truly digital gold, it should hold fairly steady against real gold, right?
Logically, yes.
But here, during a month of intense market fear, real gold went UP almost 5%. Bitcoin went down over 12%, so the ratio between them collapsed by 16%. In this specific month of crisis, the global market decisively concluded that gold is the real safe haven, and Bitcoin is just another risky tech asset that needs to be sold.
Wow, that's a brutal reality check for the whole digital gold narrative.
It really is. When the heat turned up in February 2026, investors dropped the digital version and rushed to buy the physical version.
I want to put out one more thing in this section. There's a column here called PIPS. For BTC USD, the PIPS number is negative 9,693.15. But for something like EUR, the euro, the PIPS number is negative 0.0152. Can you explain what a PIP is to a beginner? Why is the Bitcoin number basically 10,000 and the euro number is a fraction of a penny?
Sure, it's a great question. PIP stands for percentage in point, or sometimes price interest point. It's historically the absolutely smallest unit of price movement that a currency pair makes.
Okay.
For major fiat currencies like the euro or the dollar, they move in tiny, tiny fractions. So a move from 1.100 to 1.1001, that is 1 pip. It's minuscule.
Like tracking inches instead of miles.
Exactly. But Bitcoin moves in full dollars, tens of dollars, hundreds of dollars a day. The dashboard is trying to standardize the measurement across all assets, but because Bitcoin is so incredibly volatile and priced so high in the tens of thousands of dollars, a standard pip calculation results in these massive, unwieldy numbers like negative 9,693.
So it's an indicator scale.
Exactly. It essentially illustrates pure volatility. The euro moved a tiny, manageable fraction of a percent. Bitcoin moved nearly 10,000 points of value. It perfectly emphasizes the extreme risk and reward difference between trading traditional currencies and trading crypto.
So if you're riding the Euro bus, it's a gentle, buoying ride. But if you're riding the Bitcoin roller coaster, you're experiencing massive G-force.
And in February 2026, that G-force was pointed straight down into the ground.
Okay, we've done the weekly graph, which was the race. We've done the monthly table, which gave us the macro story. Now let's look at the bottom right corner, the base encounter daily. This looks like by far the most technical part of the dashboard. It's got columns labeled B, A, C, O, and RC. What exactly are we looking at here?
This is the granular day-to-day, almost microscopic view. And to really understand it, we need a very quick Forex 101 lesson for the listeners.
Gimme.
Currencies never trade alone. You can't just go out and buy dollars in a vacuum. You buy dollars with euros. Or you buy yen with pounds. They always trade in pairs.
Because it's an exchange rate.
Exactly. It's a tug of war. The first currency listed in the pair is the base. The second currency is the counter.
Okay, so a tug of war, base on the left, counter on the right.
Right. If the base currency is strong, meaning it's pulling harder on the rope, the chart for that pair goes up. If the counter currency is strong and pulling harder, the chart goes down. What this complex table does is it actually separates the mathematical strength of the individual currencies for that specific day, so you can see who is winning the tug of war.
So let's look at the AUD row again using this logic. We know AUD was an absolute monster on the monthly chart, up 14%. But here, in the BA, the base column for the daily view, it says negatives 1.30%. It's red.
This is where the nuance of daily markets comes in. Even a rocket ship has to stop and refuel.
Right.
AUD was up huge for the entire month. But on this specific Friday, this daily snapshot, it is pulling back. It's down 1.30%. Traders call this a correction or profit taking.
Profit taking, meaning they are cashing out.
Exactly. Investors have made a massive amount of money holding AUD all month, and now, heading into a Friday weekend, they are selling a little bit of it to lock in their cash. So the base is temporarily weak today, even though it's strong for the month.
That makes perfect sense.
Yeah.
Trees don't grow to the sky in a straight line. Now look at JPY, Japan. In the base column, it's negative 2.55%. In the counter column, it's plus 1.98%.
This confirms the extreme weakness we saw on the weekly split card. When JPY is the base, the main currency, it is losing 2.55% of its strength. That is a terrible, terrible day for the yen. And when it is the counter, the secondary currency, it shows positive strength. But remember...
Sorry, if it's positive, doesn't that mean it's strong?
Well, yes, but remember the tug of war rule. If the counter is strong, it usually means the overall pair is going down. But let's simplify it so we don't get too bogged down in the math. Basically, that bright red -2.55% in the base column is the daily headline you need. Japan is incredibly weak today, across the board.
Got it. Let's look at the crypto daily stats in this section. BTC x AU again, so Bitcoin against gold. The base BTC is down agate 300.19, and the counter gold is up plus 1394.37.
See, this breaks down that tug of war perfectly with actual numbers. On one side of the rope, you have Bitcoin pulling backwards, negative 300 points, pure weakness. On the other side of the rope, you have physical gold pulling forwards with over 1,300 points of strength.
So gold is just yanking Bitcoin across the mud.
Exactly. When the base is that weak and the counter is that strong, the value of the pair absolutely collapses. This daily snapshot perfectly explains why that monthly BTCX AU number was so disastrous. It's happening right now, today, at 2.37 in the morning. Bitcoin is letting go of the rope and gold is violently yanking it away.
And finally, let's look at WTI, oil. The daily base is negative 0.52%.
So oils is just cooling off slightly today. It's up over 5% for the month, but it's down 0.5% today. That's just a normal daily fluctuation, nothing to panic about compared to the broader trend.
Okay, we have literally pulled apart every single section of this dashboard. We've looked at the spaghetti race, the weekly scorecard, the massive monthly trends, and the microscopic daily tug of war. I want to ask you, as the expert here, if you had to summarize the overall vibe of the global economy on February 20th, 2026, based strictly on this one image, what is the headline?
The headline is, undeniably, the flight to quality.
The flight to quality. Unpack that for me.
Well, look at what is winning across all the time frames. Number one, the US dollar, the world's reserve currency, the absolute safest paper money you can hold.
Right.
Number two, gold, the oldest safe haven in human history. Number three, oil, the essential energy resource that runs the physical world. And number four, Australia, a politically stable, resource-rich economy that is likely benefiting immensely from that oil and gold boom.
And on the flip side, look at what is consistently losing.
Right. Number one, crypto. The speculative, high-risk future money, completely abandoned. Number two, the British pound and the euro. The currencies of economies that might be deeply struggling with energy costs or structural stagnation. And number three, Japan, an export economy struggling with severe currency devaluation.
So the market is speaking loud and clear.
It's shouting. We are scared of risk. We want things that are real. We want things that are safe. And we want US dollars in the bank.
It's honestly fascinating how a wall of seemingly random numbers can convey a human emotion like fear or caution so clearly once you actually know how to read it.
That's the real beauty of the dashboard. It's not just cold math, it's mass psychology. It's literally millions of human beings voting with their wallets at 2.37 in the morning.
And for you, the listener, who maybe started this deep dive feeling totally intimidated by the matrix of it all, I really hope this conversation has shown you that you can read these tea leaves. It's not
magic. No, it's just a language.
Right. You just have to know your basic tickers, USD, XAU, BTC. You start to understand the difference between a one-week race and a one-month macro trend. And you just have to look for the story behind the colors. Green isn't just a good job sticker. It means global money is actively flowing in. Red isn't just a bad grade. It means capital is actively flowing out.
Exactly. At the end of the day, it's all about the flow. Follow the flow, and you find the story.
I want to leave everyone with a final provocative thought to mull over. We talked at length about the safe haven concept. Usually investors pick one lane. They buy dollars or they buy gold depending on their view of inflation. But in this snapshot for early 2026, they bought both aggressively, and they completely abandoned Bitcoin in the process.
Right.
So here is the thought. If Bitcoin is supposed to be the future of money, or the ultimate hedge against the traditional banking system, what does it mean for its long-term viability if, when the global system actually gets truly shaky, everyone just runs right back to the US dollar and bars of physical gold? Why did digital gold completely fail the ultimate stress test of February 2026?
That is the exact question that keeps crypto investors up at night, staring at a ceiling. And this dashboard provides a very, very sobering data point for that ongoing debate.
Definitely something to think about on your own time. But hey, don't be afraid of the charts, folks. Like we said, they're just human stories written in numbers. Thanks for taking this deep dive with us today.
Always a pleasure to decode the matrix.
See you on the next one.